What's happening, crypto enthusiasts? Get ready for a rapid-fire update that's going to blow your minds. The market is moving at lightning speed, and if you're not plugged in, you're missing out on the biggest plays. We've got major shifts, surprising endorsements, and economic indicators that are painting a wild picture for the future of digital assets. You absolutely do not want to miss a second of this. First up, we're diving deep into a project that's turning heads, rapidly selling out its presale and drawing comparisons to the titans of the crypto world. Could this be the next big thing, or is it just another flash in the pan? We'll break down what's driving this incredible momentum and why investors are flocking to it as a potential high-growth alternative. Then, we're shifting gears to look at the big picture, with one of the biggest names in finance suggesting a jaw-dropping target for Bitcoin. What's behind this bold prediction, and does it align with the latest economic data? We'll unpack the analysis that's making waves and explore the factors that could make this target a reality. But that's not all. We're also tracking a significant development involving a presidential family and a major exchange listing, a move that could reshape the regulatory landscape. We'll get into the details of this high-profile venture and what it means for the industry. Finally, we're examining the subtle yet crucial shifts in market sentiment that could signal a major turning point. Is the king of crypto showing signs of weakness, and where is the capital flowing next? We've got all the insights you need to stay ahead of the curve. Stick around, because this is the Bitcoin Bulletin, and you're about to get the intel you can't afford to miss. Don't forget to smash that like button, subscribe, and ring that notification bell so you never miss an update. A new challenger emerges. Investors are increasingly looking beyond Bitcoin for the next major surge in digital asset value, with MAGACOIN Finance capturing significant attention. This Ethereum-based cryptocurrency project has seen its presale rounds sell out at a breakneck pace, signaling robust investor confidence and a strong appetite for high-growth alternatives in the current market. The project's unique scarcity-driven tokenomics are a key draw, designed to foster long-term value appreciation through a progressively tightening supply. This structure aims to create a deflationary effect, potentially driving up the price as demand outstrips the decreasing availability of tokens over time. Market analysts are closely watching this tokenomic model, seeing it as a critical factor in the project's potential for significant upside. By positioning itself as a complementary asset rather than a direct competitor, MAGACOIN Finance is carving out a distinct niche. While Bitcoin, with its massive market capitalization, offers stability and a store of value, its potential for exponential returns is naturally limited. MAGACOIN Finance, operating at a much smaller scale, presents an opportunity for outsized gains with even moderate capital inflows, appealing to investors seeking higher risk, higher reward profiles to diversify their portfolios. The project's cultural branding has also played a pivotal role in its rapid ascent. By tapping into broader political and financial narratives, MAGACOIN Finance has managed to attract a diverse audience that extends beyond the typical crypto-native community. This mainstream appeal, reminiscent of Dogecoin's journey from a meme to a globally recognized digital asset, has helped MAGACOIN Finance build significant brand recognition and public awareness. Crucially, this approach has allowed the project to avoid the anonymity issues that often plague newer cryptocurrencies, establishing it as a recognizable and widely discussed entity in the digital asset space. This strategic blend of innovative tokenomics, a complementary market position, and engaging cultural branding appears to be a winning formula, positioning MAGACOIN Finance as a potentially significant altcoin launch for 2025. The project is also benefiting from favorable market timing, with the upcoming Ethereum staking unlock potentially redirecting substantial liquidity into promising altcoins. As the presale concludes, the narrative of scarcity is intensifying, offering early investors a potential advantage. The project's momentum suggests a strong entry into its next phase, driven by both its inherent value proposition and the broader market's search for the next wave of digital asset innovation. Will this project continue its meteoric rise, or are there hidden risks? We'll find out, but first, let's talk about what the big banks are saying about Bitcoin's future price. Bitcoin's bold future forecast. In a surprising turn of events, the U.S. labor market is showing signs of softening, with initial jobless claims for the week ending June 21, 2025, falling to 236,000. While this figure is lower than anticipated, it remains above the annual average, indicating a gradual weakening in employment conditions. Compounding this trend, the number of continuing unemployment claims saw a significant jump to 1,974,000, reaching its highest point since November 2021. This suggests that individuals are facing longer periods of unemployment, a signal that economic headwinds may be strengthening. The 4-week moving average for initial claims has also climbed, further supporting the narrative of a labor market losing its resilience. Economists are projecting these claims to trend lower in the coming years, but the current data points towards a period of adjustment. Amidst these economic indicators, the cryptocurrency landscape is buzzing with predictions from major financial institutions. JPMorgan analysts have put forth a striking forecast for Bitcoin, estimating its fair value at a substantial $126,000 by the end of the year. This bold projection is underpinned by a significant reduction in Bitcoin's volatility, which has fallen from nearly 60% at the start of the year to around 30%. JPMorgan attributes this newfound stability to increasing institutional adoption and the accumulation of Bitcoin by corporate treasuries, which now hold over 6% of the total supply. They draw a parallel to how quantitative easing impacted bond markets post-2008, suggesting a similar maturing effect on Bitcoin. The reduced volatility, according to JPMorgan, makes Bitcoin a more attractive asset for institutional investors, smoothing the path for larger capital allocations. Their analysis highlights that Bitcoin's volatility relative to gold has reached an all-time low of 2, implying that Bitcoin now carries only twice the risk capital of gold in investment portfolios. To achieve parity with gold's $5 trillion market, Bitcoin's current $2.2 trillion market cap would need to increase by approximately 13%, translating to that $126,000 price target. Furthermore, the report emphasizes that the growing influence of institutional players and index-driven investments are solidifying Bitcoin's position as a credible investment asset. In a separate, yet related development, American Bitcoin, a company with backing from President Donald Trump's sons, is set to make its debut on the Nasdaq through a merger with Griffin Digital Mining. The company, which will trade under the ticker ABTC, is expected to commence trading in early September. This venture aims to capitalize on the growing institutional interest in digital assets, with Winklevoss twins, co-founders of the Gemini crypto exchange, among its key investors. The company's CEO has highlighted the strategic advantages of this merger, including the potential for international market expansion to accommodate a broader investor base. This move aligns with a broader initiative to foster regulatory clarity and growth within the cryptocurrency sector, though concerns about potential conflicts of interest have been raised due to the Trump family's involvement. Despite these concerns, the company maintains its operations are independent of governmental influence. These financial forecasts and corporate moves are certainly creating a buzz. But what happens when interest rates start to bite into crypto? We'll dive into that next. Interest rates, the silent threat to crypto. The cryptocurrency market, often characterized by its rapid fluctuations and high growth potential, is facing a critical juncture where macroeconomic factors are playing an increasingly dominant role. Recent market movements show a notable downturn across major digital assets, with Bitcoin, Ethereum, and XRP all experiencing price declines. This broad-based correction is prompting a closer examination of the underlying economic forces that could be influencing investor sentiment and capital allocation within the crypto space. One of the most significant macroeconomic levers impacting financial markets globally is the prevailing interest rate environment. Central banks worldwide, in their efforts to manage inflation and economic stability, have been adjusting benchmark interest rates. When interest rates rise, the cost of borrowing increases, which can lead to a slowdown in economic activity. For riskier assets like cryptocurrencies, higher interest rates can have a dual effect. Firstly, they increase the opportunity cost of holding non-yielding assets. Investors might find it more attractive to allocate capital to traditional fixed-income securities, such as bonds, which offer higher yields in a rising rate environment compared to volatile digital assets. This can lead to a reduction in demand for cryptocurrencies as investors seek safer, more predictable returns. Secondly, higher interest rates can dampen overall market liquidity. As borrowing becomes more expensive, businesses may scale back on investments and expansion plans, and consumers might reduce spending. This contraction in liquidity can reduce the amount of capital available for speculative investments, including those in the cryptocurrency market. The correlation between interest rate hikes and cryptocurrency price corrections has been observed in the past. When central banks signal or implement tighter monetary policies, often characterized by interest rate increases, the crypto market has historically reacted negatively. This suggests that the current downturn might be partly attributed to the broader macroeconomic policy shifts aimed at cooling down economies. While Bitcoin, Ethereum, and XRP are leading the market in terms of adoption and capitalization, they are not immune to these broader financial trends. The interconnectedness of global financial markets means that shifts in monetary policy can have ripple effects across all asset classes. The performance of these major cryptocurrencies is therefore closely watched not only for their intrinsic developments, but also as indicators of the broader financial climate. Investors are now tasked with navigating this complex environment, weighing the potential long-term growth narratives of digital assets against the immediate impacts of macroeconomic policies. The ability of cryptocurrencies to maintain their upward momentum or recover from downturns will likely depend, in part, on how central banks manage interest rates and inflation in the coming months and years. The current market sentiment suggests a cautious approach, as the crypto community braces for potential further impacts stemming from global monetary policy decisions. These economic pressures are undeniable, but what happens when the market leaders themselves start to show signs of a slowdown? Let's look at Bitcoin's recent performance. Bitcoin's cycle top concerns me. Bitcoin's recent inability to sustain its price above the crucial $113,000 mark has ignited a fervent debate within the crypto community regarding whether the current cycle's peak has already been reached. At press time, Bitcoin had dipped to $111,139, reflecting a 1.6% decline over the preceding 24 hours. This price action has amplified speculation that the leading digital asset might be exhibiting signs of topping out, with increasing evidence of capital rotation favoring Ethereum becoming apparent. Renowned crypto analyst Ali Martinez has pointed to a concerning technical signal on Bitcoin's weekly chart: a bearish divergence between the price action and the Relative Strength Index, RSI. This divergence occurs when an asset's price makes higher highs, but its RSI, a momentum indicator, trends lower. It is a classic indicator of weakening momentum, suggesting that the upward price trend may be losing steam despite appearances. Martinez specifically highlighted that this pattern strongly mirrors the divergence observed just prior to the 2021 market top, a period when Bitcoin eventually peaked around $69,000 before entering a prolonged bear market phase, commonly referred to as the crypto winter. The implications of such a divergence are significant, as it could foreshadow a substantial correction. Further analysis from Swissblock's altcoin vector sheds light on the internal market dynamics, providing a breakdown of Bitcoin's net position change across various market participants. Their data indicates that profit-taking is actively occurring within the Bitcoin market, with a substantial portion of that capital being redirected into Ethereum. This capital rotation is seen as a key factor influencing market leadership, with altcoin vector suggesting that, until whales commit decisively, BTC upside stays capped and ETH-led rotation dominates. This commentary underscores the sentiment that without strong conviction from major holders, Bitcoin's potential for further upside is limited, and the trend of capital flowing into Ethereum is likely to persist. Compounding these concerns, data from CryptoQuant reveals a significant trend. Bitcoin's illiquid supply has surged to historically high levels, while its liquid supply has dropped sharply. Illiquid supply refers to Bitcoin held in wallets that are not actively trading or moving, suggesting long-term holding and accumulation. Conversely, a drop in liquid supply means less Bitcoin is readily available on exchanges for trading, which typically supports higher prices due to increased scarcity. This scarcity dynamic is partly credited with Bitcoin's earlier surge above $120,000. However, cryptoquant analysts caution that this same scarcity can create market fragility. They argue that if large holders, often referred to as whales or institutions, were to initiate significant sell-offs, the limited available liquidity could amplify the impact of such corrections, leading to sharper price drops. CryptoQuant's outlook categorizes Bitcoin's current bull run as fragile, structurally supported by long-term holders, but inherently vulnerable to sharp pullbacks. They forecast two potential paths forward: either a continued rise in a liquid supply, potentially pushing Bitcoin towards $150,000 in 2025, or a return of liquid supply due to large-scale sell-offs, which could trigger a sharp correction towards the $90,000-$100,000 range. Bitcoin's potential downturn is a serious consideration, but where does that leave the rest of the market? We'll wrap up with a quick recap of today's biggest stories. And that's a wrap for today's rapid-fire crypto update. We saw MAGACOIN Finance making waves with a scorching presale, JPMorgan predicting a $126,000 Bitcoin price target, American Bitcoin preparing for a Nasdaq debut, and growing concerns about Bitcoin's cycle top amidst a rotation into Ethereum. Don't miss out on any of these critical developments. Make sure you're subscribed, hit that notification bell, like this video, and follow us on all our social channels for more real-time insights. We'll see you next time.